Hi, this is Edgar James. I'm back again to speak a little further about our business arrangement under the Community Financial Literacy Project. Before we were speaking about some of the forms of business and the different means of opening them after you've decided on the form. Now we want to go into a little bit about the impact of each of those formations and some of the things to consider. Some of them will be very nice things that work out just fine. Others are issues to consider that you may not have considered prior to considering your business. One of the questions we want to answer is who owns what in a business? And depending on the type, you'll see that that is subject to a few different arrangements. Primarily in a solo or sole proprietorship, one owns 100%. Typically that would be one who's the architect, engineer, with just one practice, maybe some helpers, assistants, but you don't own 100% of the business, and it would be reported on your personal income tax return. This form of business has exposure in terms of liability, excuse me, because you'd have unlimited liability in the sense that you could lose some of your personal assets should you suffer a lawsuit that your business contents would not cover. So in addition to having this formation, you often have to have some type of malpractice or other liability insurance to assist in minimizing your risk. Again, you own 100% of the business, so that 100% of the revenue is yours. And that amount that you earn from the business is taxable after deducting legitimate business expenses. So whether you had that money in the bank at the end of the year or not, it would be taxable as the net of the computation that I just mentioned. So you have to consider your financial planning and tax planning at the same time you do your business planning. Excuse me. In a partnership, there's different percentages owned of the business depending on the partnership agreement and the percentages that you agree to own. If you have no agreement, then by default, the business is 50-50 ownership and sharing of liability and revenue, etc. So a partnership is subject to the agreement that the two people doing the business want to agree to. For example, you could have a 20% ownership versus 80%, 60-40, or whatever arrangement there would be for the partnership to be according to your agreement. The revenue is gathered by salary, or you could borrow the money from the partnership. Typically, the net results are going to be taxable to you. If you have what they call guaranteed payments, they would be taxable to you regardless of whether you receive them or not. So you really want to understand the type of arrangement that you're under. I alluded to before the LLC formation, where when you have two or more members. That's accounted for tax-wise under either a partnership arrangement for tax purposes or as an S corporation. And the laws are similar, but the two returns that are filed are different. So one has to understand what they want the ending tax situation to look like in terms of sharing the liability or the profits, etc. How you would do that is according to arrangement. Again, in an LLC, that's called the Articles of Organization. Within those articles, each member's duties are described. Now, unlike the corporation that limited the liability to the corporation and the shares in your investment, the LLC has one member who will have to have unlimited liability, and would potentially suffer the loss of some personal assets should there be that great a risk. So that's a consideration as to which member you would be. A general member has a general liability, so you want to understand your relationship in either one of these things. Now, how would this arrangement come about? I was talking with the producer, and he was asking, what about a rapper arrangement where you have the songwriter, the rapper, musician owning a company? Well, there are other arrangements that they could as well use. For example, the incorporation. We mentioned the liability and the taxability also for tax planning purposes. If you're a solo practitioner and your revenue minus your expenses are taxable, let's say you do a concert and $5,000 is your gross, and you have $1,000 of expenses, and you have $4,000 of taxable revenue. If you don't understand that, and that you owe the federal and the state and perhaps the local government based on that formula, then you could begin to have problems there. Also, if you, whatever form of business that you're in, if you have employees, you're going to enter into the employment tax arena, hence your employment identification number, your employer identification number. That's expected that you would employ people. So you'll be expected to have certain insurances for disability, workers' comp, unemployment insurance, along with paying the federal withholding, state, local withholding, and the Social Security and Medicare piece in particular. As those are considered trust funds, if you ever fail to pay over the payroll tax, it's called, you could be subject to a 100% penalty, all kinds of things that can hamper a business by your not knowing. So before entering into any of the businesses, you want to understand from the beginning the formation, how to run it, how the personnel should function, who are the officers, what are directors, and what are the tax ramifications of the business. Each of them will have their own peculiarities, and you'd have to have the advice of a qualified, certified public accountant to assist you in preparing your financial tax returns for the Internal Revenue Service or the state or whomever would take them. Again, just to think about this, we're at the beginning of who owns what and how do you get to. The money being coming out of a corporation, if you're going to withdraw funds, for example, and that individual that I used as the rapper is incorporated. So that $5,000 gross revenue was owned by the corporation, not the individual. So the $1,000 of corporate expenses were paid, had a $4,000 item that was remaining as taxable income for the corporation. That's taxed to the corp. Unless you have a flow-through entity like a subchapter S, then it's paid on your individual tax return. But the money essentially belongs to the corporation, not the individual. So much so that the only way to withdraw the money legitimately is by salary to the employee or officer, borrowing by an officer, return of capital to a shareholder, or the fourth one, which is unpopular, hopefully, it's called embezzlement. The money that's in a corporation belongs to the corporation. So part of the thing that is going to be necessary as an ingredient would be control over the finances, and essentially that's control over your cash. Where that's the case, you're going to find your corporation, partnership, whether it be a subchapter S or a regular corp or sole proprietorship, working properly. So this is part of our community literacy project. We're interested in further delving into these issues, and we're going to be back to you on a later segment with some further discussion along these lines. Have a good day. This is Edgar James, CPA, from our Community Financial Literacy Project. Coming to you with a suggestion for a book that I had gotten 20 years ago. It's called Black Labor, White Wealth by Dr. Claude Anderson. He put no title and I took the cover page off, but it's called Black Labor, White Wealth. And it's an excellent lead-in to understanding the economic disenfranchisement of black people. So you'd want to take a read of this book as an understanding of how to affect your gathering of wealth and prosperity today. It's a very good book. I was grateful to be at a lecture where Dr. Anderson was present, and I purchased the book, and I've been, following ever since, just to get some understanding of some of the things that were suffered that preclude many from arriving at unity, pooling of resources, other foundation building that's necessary today. Get the book. It's called Black Labor, White Wealth by Dr. Claude Anderson. Another one of our books of the week.